Hi everyone, good evening. Welcome to today's special webinar on the ICICI Prudential Nifty200 Quality 30 Index Fund, a fund that brings smart, rule-based investing into the spotlight. So today we're joined by Mr. Amit Vashisht, lead ETF at ICICI Prudential AMC. He's an engineer from NIT Kurukshetra and holds a postgraduate degree from IMT Ghaziabad. With over 15 years at ICICI Prudential, Amit has led product development and distribution across multiple verticals and is now driving passive products, including ETFs, index funds, and FOFs. He'll be taking us through the strategy behind the NFO, what makes quality a powerful factor, and how this fund can strengthen your portfolio. Over to you, Amit.
Thank you, Neha. Thank you for such a nice introduction. And first of all, we start the session. I again compliment to FYERS for just focusing on passive these days. A category which is evolving, which is something which very few are talking about. Definitely, it's give a good learning to the listeners. The category which we feel will next year will be the most growing category. So thanks for this initiative. Thanks for working on this session. Thank you. Please.
So let's start off. I have a few questions to keep it conversational, to keep it fun. So my first question is, what is factor investing and how is it different from regular investing strategies?
Sure. So I'll answer the second question first. So my understanding with regular investing, we'll talk only about passive. So regular investing in passive, generally we say is plain vanilla market cap index funds. What I mean by market cap index funds, I'm sure audience know about Nifty 50. We all track Nifty and Sensex on a daily basis. We see what is the level of Nifty, what is the level of Sensex. But these are actually indexes. So what is Nifty? Nifty is basically the top 50 free float market cap companies in India. So an index which is created only based on market cap. So those are the traditional indices available in the market. Nifty 50, Sensex is 30, Nifty 100. So those are the basic which are created on the market cap. Now comes to the question, what are factor investing? So factors are, as the word says, is a rule-based investing. So within this universe, we'll definitely have to filter it out first on the market cap, and then we filter it on the basis of factors. Like the NFO, Nifty 200 quality 30, what it says, the universe is 200. Out of that, we'll take a quality as a factor. So factor is taking a particular rule. On those rule, whatever stocks comes into the account, the index will invest on going to invest into only those stocks. So it's a rule based. So again, you're getting a more model if you're investing to a factor. So you're upgrading your portfolio.
Okay, right. So,
Well,
but why does the quality factor stand out at this time of the market?
oh, okay. See, although it's again in a large cap space, a diversified portfolio, but all factors have some cycles. So if we talk about at this point of time, what we have seen a trade war is what we have seen in last few months. We have seen a war in last few months. We have seen how the interest rates are moving in US, how geopolitical tensions are shaping up. So in last 4 5 years, we have seen a lot of things are happening on the geopolitical side. And in this 5 years, market has done pretty well. So in 5 years, the market have given you better return with a lot of news now coming into the picture. People are of the view that market is little volatile. So when market is volatile and people are uncertain, they try to go to those kind of stocks which are stable, those who give us stable and quality returns. We'll definitely go and talk about how quality comes out. But as the word says, quality, it is those kind of stocks which are quality within the universe. So at this time, when people are uncertain, they prefer to go to these kind of stocks. That's why quality makes sense.
Okay. Okay, but when you talk about quality, right, what are the main parameters used to define quality, right? How are things like ROE, low debt, and stable earnings really measured?
Perfect. So quality, three major parameters are part of quality index. One is ROE, second is debt to equity ratio, and third is earning per share, as you highlighted. So when we talk about quality, the word clearly understand what we are saying. Now, within stocks, how we consider quality. ROE, what is ROE? It's a return on equity. So what is return on equity? It's basically the shareholders are giving money to the company. How well the company is using those money to generate the maximum optimization result. So that is how much return they are able to generate with the capital deployed. The one who is doing the best will get a higher weightage. So that is, if you buy a company, you want a higher ROE, that is one thing. Second, if you want a company, you want that company to be less debt driven. Because if there is low debt, you feel the company will float in the volatile scenario. So debt to equity ratio should be lower. So if that's the case, you will get more comfort, because if in that case, company have a greater financial visibility. So that's second thing you look. Third is earning per share. The earning per share is whatever share I'm holding, I'm earning per share is higher. So if I am earning much higher on a per share, which means I'm making much more profit. So these three things, you get a tick mark. You will feel that this is a quality kind of a company. So that's how quality filter out. They take these three parameters, these rules are taken. So within these three filter out, the best stocks comes out to be into the portfolio.
Okay, got it. So, what are the types of companies that are included in the Nifty 200 Quality 30 index? I mean, are there any sector preferences or limits of any sorts?
See, again, you highlighted Nifty 200 quality 30. So first we filter out Nifty 200, which means we are taking out of only Nifty 200 companies. Nifty 200 is basically a large and mid cap space. So we're not going into a small cap space. So within the large and mid cap space, we filter out 30 quality companies. Although it is not a sector bias product, but if you talk about, you'll see more of FMCG companies, consumer durable companies, pharma, some bit of IT and finance will also be there. But these are the companies who have shown a good resistance in over a long term. They have a good proven track records, and that's one of the reasons you find they have a stability in the portfolio, and that's why they filter out in this particular strategy. Although there is no fixed sectoral bias, but over a long term, we have seen that FMCG kind of a companies are one who have shown good resistance, who have a good proven track records, quite stable. So that's one of the reasons you find these kind of a categories more into quality.
Okay. Okay, but how is this index built and updated? Is it like a rule-based approach, or how often does the stock list change?
Sure. So it's a pure rule-based index. So any index in India, we are mimic, it's all rule-based index. There is no active management in this. That's what's called passive. And within, because of rule, people sometimes say it's called smart beta, or you can say factor investing, because it's working smartly for you. So it's a pure rule-based, and it's semi-annually rebalanced portfolio.
Okay. Okay, but how has the Nifty 200 Quality 30 index performed over time, right? Especially when compared to Nifty 200 or Nifty 50 during tough market phases.
See, over a long run, Nifty 200 quality 30 has done tremendously well. He has seen across the cycle. So if you talk about the cycle of 2011 to 14, when market was quite volatile, 2018 market, or in COVID era, in all these scenario, quality have outbeaten Nifty 50. So when we have seen the uncertainties happening across, you generally see quality will outbeat the Nifty 50 or Nifty 100. So these scenarios clearly it has outbeaten.
Okay. Okay. So why should investors consider this fund right now for the long term? Right? What makes it a good option in today's market?
Okay. See, again, we have discussed, I just to reiterate and then we'll discuss in detail. In the current market, in last 4 years, if you see 5 years post-COVID, market have given a decent double-digit return and upward of double-digit return, some 20% plus. So if you talk about that kind of return, it is a very good experience that clients have seen. And in last 5 years, clients have not seen any financial year negative return also. So if you talk about past experience, returns are superbly well. In somehow in last 1.5 years, we have seen a lot of changes happening globally. Geopolitical tensions, we have seen how it's shaping up. We have seen how the trade war is impacting the businesses across. Every business have to now change their strategies. The countries are changing their strategies. And with this all happening in short span of time and market have done so well, now people are looking for a more stable portfolios. So, and again, when you talk about more stable portfolio, people are looking for the companies who can give you a long run, a stable return, those who have proven track records, those who have seen the cycles. So those kind of companies fit very well in quality as we discussed, because of ROA is good, the debt equity ratio is very good, earning per share is good. So all these three things, if it's good at this one time, these companies able to manage their wave very well, and over a long run, they're able to give you a good compounding return. So that's the advantage of this particular product.
Right. Makes sense. If you could shed some light on who this fund is suitable for, right? If someone's looking for stability or someone aiming for long-term growth, who is this fund really made for?
See, the good part is this is universe is larger mid cap. So the larger mid cap is a decent universe to start with. Your core portfolio should be into a large cap space or a mid cap space. This product is definitely going to filter it out. Out of that, we are going to filter it out 30 companies, which is again we are working on that as a space. So you can consider to be a core portfolio because your companies you're buying are the quality companies, which means they have shown their track record, they have proved their track record over a period of time. They have seen multiple cycles. So anyone who is thinking to invest for the long term, there's an ideal product, they can look for it. Low cost product, good track record, have seen all the cycles. So long term SIP or long term investment, this product is an ideal product to start with.
Okay. Okay. So can this fund be used as a core part of someone's portfolio, or should it play more of like a supportive, passive role? What do you think?
I think this should be part of a core portfolio because again the stocks are selected 30 stocks, not you buying 70, 80 stocks universe. Those two stocks also are part of the majorly large cap, mid cap of the space, so highly liquid stocks. All companies you will find in this as a portfolio have seen a historical trend also. So overall, this should be part of the core portfolio and should be considered to be an SIP or should be considered for lump sum as well.
Okay. Right. So finally, can you please walk us through the key NFO details like expense ratio, SIP options, taxations, and how to invest?
Sure. So in NFO, the period is open for 15 days, so the product is available. And post that, you can also invest into the scheme. You can invest to SIP. You can invest with a lump sum as well. The expense ratio is somehow which so we have two options. One is a regular, one is a direct. Good part is SEBI have categorized passive to be at max 1%. So that's the highest expense that can go into the fund. So you can expect a regular expense between 80 bips to 1%. We are not sure what the exact expense is as of now. Depend upon after the closure of the NFO, we have some expenses and all those things. But will be between 80 bips to 1%. That's a ideal expense which you can expect from this in regular. Direct would be between anything between 25 to 35 bips. Again, it all depends upon the cost that comes out to be in this product. So that's a range as of now.
Okay. So those were the questions from my end. Do you have anything to add?
Yeah. See, I reiterate quality. Sometimes people think boring, but trust me, boring is sometimes so well. The people, those who have run SIP in last 10 years are the most disciplined people, a most boring thing. But those people have made the best return. So trust me, if you make your investment boring, you will go long run, you'll make your money very well. So that's what we feel. If you think about quality, quality gives you a stability. You might not see a linear one side rally, but over a long run, you'll get a much better and stable risk adjusted return. So that's what I always suggest whenever you're investing, think of risk adjusted return. Type of risk you're taking. Are you able to get that kind of return? That's more important. If you think yes, look into that as an asset class. So I'm sure this will give you a much better experience over a long run as well. Do look into this as a scheme. Do look into this as a strategy. And happy investing to everyone.
Okay. People say old is gold, but I think you would say boring is gold.
Yeah, definitely.
Great outlook. So, thank you so much, Amit, for such a clear and practical explanation of the Nifty 200 Quality 30 Index Fund and the broader concept of, quality factor investing. From index methodology to real world application, your insights really made this a valuable session for investors across all levels. And thank you to all the attendees who joined us today. Stay tuned with FYERS for more such educational sessions that simplify investing. Until next time, trade smart and invest smarter.